Hello and welcome back. My name is Josh and this is Finance Soup. And today I want to discuss how interest rates impact different investment vehicles. Previously I discussed real estate, and today I want to discuss two other ones, how they affect bonds and how they affect stocks. So first let's start. What is a bond? A bond is basically it's a loan. It's a promise to pay someone back. When you take a mortgage out, you are taking a loan and you're saying, I will pay you back all the money plus a little bit of interest. That's really all a bond is. The government can sell a bond. They'll say, hey, we want some money now, and we agree to pay you back in the future. A company can do that if they're trying to raise money. So a bond is just a promise to pay back plus a little interest, and you can think of it like a loan, similar to a mortgage. Obviously, we know what a stock is. Stock is an ownership in a company. Now, they make money in different ways. Company makes money by running a business. And from that business, they can make profits and they can pay those profits back in the form of dividends, or they can keep those profits and you can sell your ownership if people think it's going to be worth more in the future. So, as a company makes more money, revenue goes up, people say, I want that. I think it's going to be worth more in the future. So they buy it. And bonds make it based on interest rates. As we can see here, this is the 10-year US government bond. You can see a pretty clear trend line of bond rates going down over time. And actually, if we compare that to interest rates, this is just general interest rates in the market. You can see over the last, if you look since the 80s, actually, let's do this. Here we go. They are pretty strongly correlated. Again, that sharp decline down. Now, again, they're not exactly the same, but they're very highly correlated. And so when interest rates are down, bonds are down. So we can speak about them fairly interchangeably. Um, so when bond rates are high, again, because a bond, especially a US government bond, it's a promise from the government that they will pay you back. If the government's willing to pay you back 15% interest per year, that's a lot. Again, stocks return on average 7% per year. Do you think the U.S. government's going to go bankrupt? Maybe now people think they will, but in the 80s, I don't think people did. And again, it's unlikely that they would. So 15% guaranteed return basically is very safe. So this is really what we call the risk-free rate. The risk-free rate is we assume the U.S. government's not going to go bankrupt, so it's risk-free. Again, obviously people might disagree, but it's basically risk-free. So stocks need to get a premium over the risk-free rate. You wouldn't take risk unless you thought you'd get more than the risk-free rate. If I told you I could guarantee you $1, or you could bet me based on a coin flip, I wouldn't say if you win you get $1. No, you'd say I need more than $1 because I can get the dollar for guaranteed. You'd probably say I want $2 because you have a 50-50 shot. Maybe you'd even say more because 50-50 shot is your expected outcome. 50% of 2 is still 1, so why wouldn't you take the guaranteed 1? Maybe you'd say I want $3 on a coin flip. So again, you want a return over bond rates. So when bond rates are high, that means people are willing to pay less for stocks because they want a better return. Basically, if you're paying less for $1 of earnings or for a stock, you can have a better return. When interest rates are low, you don't need as much of a premium to buy a stock. So this is where it comes back to PE ratio. So what is a PE ratio? If you Google any stock, you'll see here a PE ratio. So that's a price to earnings ratio. So what is a price to earnings ratio? Price to earnings ratio is the price you're willing to pay for $1 of earnings. So this is the price 149 divided by the earnings per share. Or you could look at it as the market cap divided by the total earnings, either way. So typically what happens then is when interest rates are low, PEs are higher because you're willing to pay more for that earning. And vice versa. When interest rates are high, you're not willing to pay $42 for $1 of earnings. Another way to look at PE is how many years it takes to make back your full investment just in earnings. So again, if you're making $1 in earnings, it would take 42 years to get back your earnings. If the PE was 12, it would only take 12 years to get back your earnings because again, you're paying $12 for $1 of earnings. So again, if you waited 12 years, you get $12 of earnings. Again, it's not exactly the same because some stocks like Tesla, has a 385 PE. but that's because their earnings are growing so fast. But I'm assuming a stable business here. Might be a bad estimate, but again, we're trying to understand why interest rates impact stock valuations. So again, really what this is saying is when interest rates are low, just like how it increases stock prices, or sorry, real estate prices, when interest rates are low, stock prices go up because people are willing to pay more for that premium because you are getting a premium over what was interest rates now? They're about 1.5%. If you want to make more than 1.5% on your money, you need to go into stocks. So more and more people are willing to buy stocks, and that drives the price up. So I hope that was helpful. This has been a bit about how bond prices correlate to stock prices. We can do one more video in this series about PE ratios and how, a little more in depth about how interest rates impact PE ratios. Thanks for watching and talk to you next time.